Transeo Academy session. Good morning, everyone. Many people from different countries. We're really happy of this success. Hello, everyone.
Hello.
So we will wait maybe 1 extra minute. Yeah, welcome. So it's our pleasure to welcome you for this online Transeo Academy. It's a pleasure to host Grégoire Buisson is like a great expert across Europe about valuation and the markets. And so let me briefly introduce Grégoire. So Epsilon is the CEO of Epsilon Research. It's an independent research and financial analysis bureau specializing in the private company M&A and private equity markets. So they conduct research, they deal analysis, market intelligence on M&A deals. And they were set up back in 2007 by Grégoire, and now he has a team growing every day more. And so it's really a pleasure to host him today. He was already there for previous Transeo sessions, but we thought it might be really interesting to offer our members insights about the European M&A markets and also about valuation trends. So Grégoire, the floor is yours. You will have approximately 30 minutes to present, and then we'll invite everyone to go in breakout rooms to have small discussions, and then we will move back all together in the main room to exchange about what we've been discussing, and also you could ask your questions to Grégoire. So Grégoire, thank you so much, and I will leave you introduce yourself and start the presentation. Thank you.
Okay, well, thank you, Marie. Thank you, the whole Transeo team, and also to give me this opportunity to present some of the results of our research and to such a very diverse audience, both in terms of countries, and also I see there are both M&A professionals and people from universities and very different background, and I'm sure that's going to make the discussion very interesting, and for us to have the feedback on what we're doing. Also very much looking forward also to the second part of the questions. So very quickly, I will maybe share my screen and just show you just a short presentation. I'll start with Epsilon. It's going to be short, but I don't know how. Let me share, for instance. Okay. I don't know how familiar people are, or maybe some of you may know Epsilon. Very quickly to say what we're doing so that you know where we're talking from. So we set up, and I started this in 2007. So that means I've known a couple of crises since then. We've started a company building, software data analysis for really the private M&A market. So that means both, M&A advisors, private equity funds, evaluators, and in that we've kind of set up 3 lines of business. The first one around and the key database we've built, and we're going to talk about a bit more because this is really the basis of a lot of our research, is a database on M&A transaction multiples in Europe, and I'll say how we've built it. It's a long work. Also, other data we are building, on private deals and M&A deals. So it's really around private M&A markets. The second, with the research part, different kind of publication we are doing. The most known is the Argos Index. So we've done that for, now more than 15 years, and building an index on private company prices on the Eurozone. And that's, again, very much one of the bases of the presentation today. Also, we publish other, studies on the M&A market, and prices can be with other institutions, for instance, on the French market. And we were talking with Transeo, saying how I would like to do that on other probably on other European markets, and on also different sectors. So that's really the research part, and which is very much based on the data we're building. And the third one is more around software and CRM project management suite we've built for again lots of independent actors, whether they are M&A advisor, investment funds. And this is a part on which maybe we'll have a talk about. We are starting to implement AI tools. So that's interesting because we're in the middle of, what are AI tools going to change on the market, on the M&A market? And we're pretty much in the middle of that, see what kind of tools we can build, with concrete results, just not buzzword, but, what can actually do and not do using AI. So this is, as you see, so actually two feet for Epsilon, one around data, the other around software. So the key thing, and I'll go quickly, but I don't know again how much people in the audience know about Epsilon, but the question is where is the data coming from is key on that market. And very quickly, the starting point, if we talk about private, is that there's no real reliable information on the deal prices. This market is fundamentally opaque, with few information you can get, and actually not only few, but less and less, actually, especially on prices that are in, for instance, press releases. And the information you can get from listed company prices is not always very relevant, much more volatile, question of comparability. On transaction multiples are not really reliable. And the reason is just the information just doesn't exist in the market. You have to reconstitute it. And so if you take classic M&A database, they're doing a lot of things, but one of the things they don't really do is give you real useful information on prices and multiples. You have to build it. That's what investment banks that have significant in-house resources do. And that's actually what we do. So that's what we've done for a number of years. So the way we work and is the way you can get information on private deals is really, you have to go through every available data. That means not only, of course, price or price release, but that means also annual reports if buyers or sellers are listed. That means number of information on the company holdings and find the accounts, find the board minutes. So you have to go in that kind of details to be able to reconstitute a deal, which works statistically for us. I mean, we know get a price and multiples in a third of the deals that we study, which is a lot on private deals. So today it's like more than we've online more than 10,000 reports on detailed reports on transactions, and that's really the basis of the study. So it's usually quite developed, and the key for us is not, again, because it's an opaque market, is we don't say, this is the multiple. We just the key for me is really the traceability and transparency as to where do you get information from, what kind of restatements or assumptions we've made to get to the multiple. Sometimes we're pretty sure, sometimes we're much less sure. But the key in that market is really to be to is traceability. How so that on the other side, evaluators' point of view, they can assess as to can I use that transaction, that multiple or not. That's really the basis for us, and then you can constitute that kind of list of comparables. But the key is not the table; it's that's the summary. But behind each of them, the fact that you can see the detailed report as to what exactly is that company doing and where is the data coming from. So that's the basis of one of the key so indicator we publish with the Argus index. Again, I guess it's now translated into 7 languages. The last new one was Spanish, so it's like 6 European language, but also Japanese, because we have a number of Japanese investors, large investors interested in private equity European private equity market, and they were very interested in that study. So that's why we also publish it in Japanese. But just to remind you, the way it's built, it's a quarterly index, and we're trying to measure the evolution of the Eurozone private mid-market companies. So it's like 20 years of data. The key indicator is the EV on historic EBITDA, and it's on the 6-month rolling basis. And by mid-market, we mean companies with equity value between 15 and 500 million. So it's quite large, and you have actually sub-markets within that mid-market, say upper and lower mid-markets. It also important that the dynamic for SMEs and for small companies, we of course it's in terms of level of EBITDA are much lower. So it's interesting that study when you study in terms of relative prices, so how it evolves in time, how it compares to the absolute value of the EBITDA is just a median for a market. It's not relevant, of course, for any valuation work, but the purpose is really to try to illustrate what's the market dynamic. Again, we're starting with a very opaque market. We don't know really what's going on. So the idea is to give a bit of light and say what's going on in that market. And again, because we've done that for so many years, and with the same, it's a lot of work behind it. So it's become kind of a reference for a number of both PE funds or advisors or investment banks. We find it a lot and more in the press, etc. So it's a good starting point, and starting with that kind of data on the Argos index to try to understand. That would be on the two things I wanted to say today. What kind of observation that we have, 20 years of data, two complete economic cycles, so we can try to start to use it as a way to understand what's going on in the market and establish maybe ex post factors that have an impact on the value of private companies. And you have, of course, two kind of drivers. I'd say the external drivers, which are linked to the macroeconomic and financial conditions, and this is something we try to analyze, and the internal one, which are more linked to the characteristics of the players, i.e. of the deals of the players involved, and what kind of impact can it have on the prices and the private transaction prices. So this first, and then we'll see more, what's going on. What can we say about the 224, both M&A activity and multiple trends, and what we see for this year. So first on maybe longer term observation. First external determinants of the market, well, just as simply as time. And of what we know over the long term is that prices, pretty much like M&A activity, are cyclical. They evolve with the economic cycle. So it's something just we can now, with 20 years of data, we can see that the economic history is marked by periods of global M&A waves, linked both to macroeconomic factors, to regulation, to periods of innovation, which explain this M&A the cycle. But also the cycle is also linked to maybe more microeconomic supply demand dynamics, and we'll see that it's a key factor in what went on for the last 10 years. So we'll come back to that, but it's that supply demand dynamic, which I think is key. What we see also is that, interestingly, there's approximately 50% price variation between high and low, high and lows in a cycle. If we see the global financial crisis 2008, they were kind of the market went down 50% in terms of price. The Eurozone crisis was minus 20%. And COVID crisis was up also by that kind kind of level. So we can see the amplitude. I don't know if it works in English within a cycle. But there is another factor which I find important and interesting in that graph, which is what happened since 2016-17. We have a divergence between the price increase and the drop of M&A activity. That was actually accentuated with the COVID crisis. It's not like we had before in the first 10 years of the graph and even before, kind of the M&A activity that support prices. It looks like pretty much the opposite. And it's more kind of the rarity that would determine the price. So there's a shift in the price formation. It's like to sum it, it's too much money for too few deals. Behind it, you had the huge and constant growth in capital raised for private, the private market, private companies. But so it like for the last 15 years, 2-digit growth every year. So that we have today huge sums. I think it's more than something around $13 trillion worldwide going to alternative assets, mainly private equity. And on the other side, I believe you have a limited pool of companies on which can get this money. So result was just higher prices. So I think it's something which really was new and in how prices are formed is this impact of rarity, and again we're here the supply demand with a strong supply of funds and limited demand, which is behind this very continued and strong uprising of prices. We'll come back to it. So second idea about comparison between listed and private is of course private prices are less volatile that which is expected intuitively. Reason is just the price setting mechanism on the private market is different, and we have long negotiations and longer time frame. Cost of capital is not spot. So it raises a question, especially for asset managers, to the correlation between listed and non-listed company prices.
Grégoire, we
yeah.
have a question from
Sure.
Oscar
Yeah.
in the chat. So are these numbers
Okay.
inflation corrected? We had some inflation since 2013.
No. This number, you mean the price? No, it's the price is in the multiple of EBITDA. So it's not even the price of company. So that's where here it's not very comparable in a way that here you've got the Eurostoxx in here you've got just our index in terms of multiple. I just wanted to see is there some correlation between the two? That our prices are just a multiple of EBITDA. So it's a bit different. So the question that actually the correlation is interesting. You can see that there is an impact of public prices and private prices. Of course, we swim in the same sea, and we have the same macro or economic conditions affecting both assets. But also you have, it's something I wanted to highlight, an interesting impact on the fact that impact of listed buyers on private companies' prices. We've had the idea was that listed buyer, you could see all the more active that the equity market prices are higher, which is logical. And then it's kind of the drive belt, one of the drive belt from listed to private prices going through listed buyers. That was very much the case in 2008. And you see, we'll see in another graph that the part where there was a strong increase in prices were linked to, especially to listed buyers, which inflated price on the market at a clear, the equity market had a clear impact on the private deals. But the other, if you look at the comparison here again between the EBITDA multiple between listed and public companies. Here we use one of our partner ID Midcaps on the French market. And I think it's very interesting. Well, here on this graph, the comparison between the Argos index, which is here in green, and the CAC Small. And what we have is a divergence and a growing gap between the prices of private companies as measured by the Argos index and public companies as measured by CAC Small. And what we found is that, well, if you suppose that control premium is stable, and actually ID Midcaps has shown, though I didn't show you the graph, but actually it's even a little bit increasing over the last 10, 15 years. But if you say super stable, what it means is that the liquidity premium is decreasing and at historical low, because just the difference between the two, one is control premium because the Argos index is based on acquisition of majority. It's majority deals only, so you have a control premium included. And of course, on the public part, you have no control premium. This is minority listing, but you have a liquidity premium. But here, so if you, the fact that you have got a growing gap show that intuitively you can say that the liquidity premium is going down. And probably you can analyze, I mean, there is both the fact that you have a reduced liquidity on the lower end of the equity market, and that could be linked to a number of factors from MiFID II, the fact that the coverage is diminishing, the investors are more focused on larger companies, etc. And on, in parallel, you have increased liquidity on the private market, and that's the impact on the private equity funding growing a lot. So it's interesting because here you can explain also why the number of companies listed, especially on the smaller end, is just decreasing over the last 10, 15 years. And it's a question that both on the London Stock Exchange, the Euronext, or they're trying to address. But based on that, it's going to be difficult if you see that graph. But it's something that we've seen again in the comparison between listed and private prices. Behind is this question of liquidity premium. Other observation now, it's more recent, what's the impact of interest rates? And we raised that questions with the recent, the post-COVID, very strong increase of interest rates. And just we know that on the two factors behind this long, increasing prices like 10 years on the market, you had two things. You had both. One is very low and even negative interest rates, with have an impact on the valuation of every asset, so including companies. And the second was the supply demand dynamic I was talking about. So question what's the share of each of them and what's the impact of interest rates? So we use the try to correlate again the Argos index here and the 10-year EU bond yields calculated by ECB in reverse, and we see it seems very much correlated. So we did a very simple, correlation with a 6-month shift. To suppose there were 6 months lag between, the lower or higher interest rate and the impact on the M&A market. And indeed, if you don't put that 6 months, then the R2 is a bit less than 0.5. And very interestingly, there is kind of a strong correlation, and you can say roughly, again, it's a rough statistical analysis, but still interesting to say that you could say that half of the price increase in the last 10 years was due to very low and decreasing interest rates. And what we see today is that this is where we are. So interestingly, based on our regression line, we could say that the price should be lower. Company prices should be lower. We'll come back to the recent results on the Argos index, but in a way you can say either it's because as private actors they expect the interest rates to go down, which is the case, but we need to go down to 1% to justify that kind of level. Or that means that probably prices should go down. But again, what she tells us is maybe the second explanation of our bull market in terms of prices, i.e. the supply-demand dynamics is key. And what we've seen, including between COVID and including recent periods, is that the amounts of capital flowing into private markets still is very strong and growing. So that might explain why prices today are high and maybe higher than we could expect based on the level of interest rates. So it's this is a recent graph we've produced, so we probably should we'll see with very much of interest what's going on, both in terms of where the interest rates are going to and what kind of impact it's going to have on our prices. But this is the kind of tool that may be interesting to understand. Again, it's the idea what's going on in the market. Now another observation, again, there are many. I mean, on each of these points we could talk much longer, but I'm trying to bring what kind of information we can get from the data. Interesting for me, and the graph started in 2014, but we could go. It's a bit long to produce, but earlier because it's something we've seen on the longer term, and since database started in 2004, the data is really a convergence between Eurozone countries, except in periods of crisis. And we saw that in 2008, a bit in 2012, when micro financial conditions differ between countries, then you can start to have logically an impact of cost of capital and then company prices. Here it's a bit different. It's not the different macro financial conditions. It's more difficulty during the COVID crisis. We had much a reduced sample of data, and deals that have stopped on a lot of sectors, except on the healthcare and tech, where the multiples are high. So it has very specificity in the sample that would explain that. But if you look at the other part of the different trends between countries, the convergence is clear on the longer term, and that's an important result for the valuators. And we have a number of valuators in our customers, and I always say to them, don't look just at the multiples in your country. It doesn't make sense. The list of comparables should be European for most sectors, just because the sector and the size effect have much more impact on valuation than the country effect, and which is much lower. And even if you take, for instance, Italy, which is a bit, if you take the longer term, an average, the multiples a bit lower. It's very much, I believe, explained by the different mix in the sectors. You've got, we see for Italian, there's a number of industrial and deals maybe that have an impact and now have multiples lower than other sectors. So that might be one of the reasons for the fact that Italy multiple seems a bit lower. But otherwise, convergence is the clear trend. An impact of euro in part of internal market is clear on SME prices, which I believe is an interesting result. And then if we go very quickly on maybe more internal value drivers, of course, the first one is size. It's an old graph, but it hasn't changed. I mean, I could update it. It hasn't really changed. What we see is that the segmentation of M&A market is key to the price analysis, and we have behind the macro, the effect of the size effect on transaction prices is not linear. You can see it's like a stair. You have market segments where the organization dynamics, the type of buyers, the cost of capital differ. So it has a strong impact on multiple, but again, it's not linear. It's really, especially on the smaller end of the market. For another study, we see prices between less than 5 million, between 5 and 15, 15 and 50. And you can see, for instance, the 15 to 50 mid-market, that's where you start to have a number of LBs, and they have an impact on the market, where you start to have more international buyers, which also have an impact on the market. So again, impact of price is clear, not linear, and probably within the small market, less than 15, I was saying, a further segmentation would be necessary, and you would see again a different impact of the size, and also size effect change with time. When we 10 years ago, for the first 10 years of the Argos index, for 7 years, the segment we were studying within the index was 1,550, and then we added the upper mid market. When we did that, we study, of course, and say, well, intrinsically we're gonna push the index higher, and actually it wasn't the price, because at the time and for the 3 years we studied that, there were not much difference between lower and upper mid market multiples, but it changed. Don't remember the year, but somewhat 2016-17, and then really we saw the upper mid market pushing up and having a clear effect on the Argos index. So again, the size effect might change also a bit with time. So last thing, and I didn't put the slide on the effect of sectors, which is also obvious, but just to give you a bit of caution on data interpretation. Of course, first we're saying about the fact that the Argos index is only meaningful in relative value. And also one of the reasons, of course, is multiples differ greatly between sectors. But not only between sectors, and it was one of the explanation between what happened during the COVID period, we'll see, is the effect of the changing mix of sectors, the fact that you only had tech and healthcare deals pushed the index much higher. It wasn't just that the price were going up, it was that in the mix of sector in our sample, there were many more deals with intrinsically had higher multiples. But also in terms of, I know maybe there are a number of valuations, people doing valuation in the audience. The fact that even within sectors, there is a high standard deviation. So the sector analysis is not enough. And that's why we don't publish, and we refuse to publish sector multiples. I think it doesn't make sense to have it makes sense like the Argos index in relative value, but in absolute value, giving a multiple for the food industry doesn't really make sense, again, unless you just wanted to compare with other sector or in time, but in absolute values doesn't make sense. And again, even if you go down and be precise, more and more precise on the sectors, you see standard deviation is still high, and just the reason is there are a number of other drivers within a sector. And so that needs, for every evaluator, a deal per deal analysis, see all these other drivers, whether it's growth, margin, positioning, or a number of things. So in a way, we're not going to automatize valuation. It just doesn't work. We need experts, and we need to interpret the data. And there are many things which are encapsulated into a multiple, and not only the sector, but as we've seen, there are many different drivers, and that's where experts are needed just to make the right interpretation. So after having analyzed some of the value drivers and starting to see again impact of external versus internal characteristics on price of of private company prices. Let's move on to see more recent trends and interpretation of what's going on in the market. So first thing will be, I'd say, what's the post-COVID trend for mid-market prices? And maybe we should come back very much into three trends. The first was the prices, long run and during pre-COVID, but also post during COVID crisis. And prices went up clearly with the same drivers I was talking about, mainly extraordinary financial conditions, especially, very small negative rates, which had, of course, an impact on all prices. And again, the capital raised and invested in private equity. The raise, it's approximately, on average, is half a point of EBITDA per year for more than 10 years. So that's a long run. Then what happened since the second semester 2021 is then you had a 3-year price decline. And of course, that was linked to strong inflation and very, hikes of interest rates, which had an impact on every asset price, including companies. So we're not going to go back too much in details and all the factors behind, but and what's interesting was the rebound since the second semester 2024 to 9.8 times EBITDA. This is not what I was expecting, but it was clear. It was pushed by both. We're studying prices paid by both PE funds and by industrials, and both were up above its long-term average. And again, it was due to starting in financial conditions starting to improve, M&A activity, and we'll come back to it, starting to recover, and expected, after 3 years of restraint, it seems that things are getting better. That was for the last semester. Behind this, interestingly, what we look is the polarization of the market. The share of the sample with multiple with less than 7 times or more than 15 times. And although we had logically a very high share of multiples above 15 times when we're at the top of the market, and starting in 2023, and that's where prices started actually to move down starting here, where we had less deals at above 15 times, especially not on the tech part, and slower growing share of multiple of price paid at less than 17 times. So it always takes time for the adjustments between buyers and sellers' expectation, but clearly the trend went up, and especially for multiples less than 7 times, on the contrary to more than 15 times. This way you see the pressure on the market on prices, which you can measure then by the Argos index. But then more recently, it was this semester, interestingly, you have the share of extreme multiples was down to 33% of the sample, and that's below its 5 years average, and it coming back to more normal conditions. And including here, we see for the multiples above 15, the share multiple above 20. Mostly, of course, what you would expect, tech and healthcare deals, but not only. But so it's interesting because here we're trying to measure also what's the within the market and what's behind just this median multiple that we give with the index is what's going on within the market, and what's the dynamics within the market we're trying to measure. Behind this, there was actually a slow recovery of the Eurozone, M&A, mid-market M&A activity. What we see is that the market is recovering slowly, actually, since the COVID crisis. And especially if you see the quarter per quarter, it's an estimation, it's going up a bit. And there's a renewed activism from both corporate and private equity funds. Again, fueled by improving financial conditions. We were that was last year. Things are changing quickly, so of course it's always so you have to come back a bit back in time, and indeed that's what we were seeing. We saw that kind of improvement much quickly in the global M&A market, which what you find in the press is usually on M&A is or mostly really talking about very large deals in value. So it looks much more volatile, but it's in a way it's not the same market. Our market was private, small mid-market deals, in a way more stable, moving slower, but being the hidden part of the economy. So that's the what we can say about the M&A active mid-market activity. However, it's slow, but also it's fragile, and it's especially interesting to see it's fragile. One, of course, today because we see a challenging, to say the least, political and economic outlook, but also already in the S2. Actually, we produced those figures about Q4 2024 in front of the French press, saying, well, market's going up, price going up. However, this is not at all what we feel in France, since the political dissolution and political uncertainty since July. And actually, what you don't see in European data, but you see in France, is that the French market was down 15% on the second semester, going reverse to every other European country. So that you can see, and especially I'm talking with Argos and other people on the market were saying, well, lots of these deals just stopped very abruptly. So this is so we feel the market is really stopped here. However, this is where it's interesting to see rest of Europe was much more optimistic about the recovery. So behind this, interesting, maybe we can do a zoom on the LBO market, because first what we see is that the M&A activity and the graph we saw on the increasing activity since COVID was actually also supported by a slow recovery of the mid-market, LBO mid-market. But we measured the share of LBO, and that it excludes build-ups within the M&A market. So it's building up slowly but surely. But in terms of activity, 2024 compared to 23, it's up. I mean, in deal value, 22%, 65% in disclosed value, quite significant. So we can see activities picking up. Again, let's keep in mind that the dry powder is still very high. Fundraising on private market is still there. So the LBO activity just didn't stop. And today, they still hold a record number of companies for sale in their portfolio. So what's interesting to see is their impact on company prices. And we believe more and more that they have really a key role into shaping market prices. If you look recently, multiples are up 10.3%. Maybe they benefited more. They were actually waiting for this decreasing borrowing costs, even though it's higher and easier access to deal financing. That's what we see on the market. However, what's interesting, especially since COVID, is the gap between price paid by PE funds and industrials. If you look at logically all the periods up to 20 up to COVID, on average, industrial companies would pay maybe 0.2, 0.3 times more EBITDA, which is logical. It's what we learned about, synergies that they can have, and they can pay it a bit better. But it has changed, and it's kind of a structural change since the COVID market. And you see, and that's very interesting, if you see the impact of the price peak in 2007 and in 2021, 2007, that was really fueled by strategic buyers, and what I was saying about most of them being listed and the impact of large industrial groups impact on the private prices. That was at that time. But here, interestingly, it was really PE funds that pushed the prices up in 2021, buying. You're in a very competitive market. It hasn't changed with COVID, and they were paying for, of course, the most qualitative assets, but they were pushing prices, transaction prices up, and it actually still the case. You've got 1 point gap if you take the average in the last 3 years difference between the two, and you can see that they have a key role in terms of number of transactions in the market share. Not only in primary deals, but also with build-ups. And they actually, shape the prices. It's been the case in the last 3 years. So the role, you see the role of PE funds is a long history. It's 15 years, market share increase in the M&A market, but it also has an impact on prices and what we see on transaction prices.
Just
now,
Grégoire, 1 minute,
it's my last,
1 or 2 minutes left. Yeah, great
timing. This is my last slide.
Yeah, thank you so much.
Just quick idea about lower and upper mid market. We are also studying the lower segment, 1550 million, for French National Accounting Association. And what's interesting, again, that's for French companies, but it's the impact of the fact French is negligible. It's really the fact that it's a smaller end of the market, which is interesting. And what we see is that there was an increasing gap for the last 5 years, which is actually a bit closing down. Especially, we saw SME prices were more affected by the crisis than the upper mid market. It seems logical with an increasing gap, but it's not closing as market conditions improve. Which leads me to just, what could happen this year. If you look at the longer trend, probably we can say, well, we can expect the actual, M&A activity trends to continue its improvement, and maybe having a pause in the price recovery. One of the reasons being interest rates still being high, and we saw the graph saying, well, either they go down quickly, or prices will have to go down, so that it makes sense, I'd say, financially. However, the probably these kinds of prediction are now irrelevant. We can say that in a way the Trump world is a new world, and the question more now is how is the Europe economy and the M&A markets are going to adapt to the coming storm, which makes provisions at this point very difficult. The only good news we could say is based on the history is that private markets are more resilient, have proved more resilient in terms of activity, especially your prices, less volatile and more resilient than public markets for larger deals. And maybe better, it's a better place to where we'll see how we can resist the storm. But otherwise, I would say here this is this is not a good timing to prolong the trends and try to make some assessment of what's going on for this year. It's going to be turbulent, and maybe we can try to use what's went. And we have a couple of in the data of crisis where we could see how the market responds. Maybe we can use that to see how we will respond to the coming crisis. But probably that's an open question, and maybe to come back to the next phase of the this academy is the question part. Would be interesting to see, as we have very different countries, different in Europe, how they see the market today, both in terms of activity, prices. We are quite pessimistic in France, but it's for very local reasons. And that would be very interesting to see with different perspectives how people sense the market for this year.
Thank you so much, Grégoire. It was really insightful. If you have questions, maybe we keep them for the end. And now we invite you to move in breakout rooms. And during the previous academy session, some of you left. So please try to stay till the end. We'll try to keep to maybe 15 minutes in breakout rooms for discussion. So as Grégoire explained, please share with other peers, other members, your impression about the market and everything that was said about valuation trends. I think Laura is ready to send you in breakout rooms.
I am, but Teams is not, so it should be any seconds now, but I will open the rooms. You will be directed automatically, and then we will post a message in each group saying that you have like 2 minutes left, and then back to the main room, and we will share the discussions, and Grégoire will wrap up the session. So I will try to open the rooms, and we will see if it works.
Thank you so much. So we hope you enjoyed the discussion. Sorry, it was a bit shorter than initially planned, but we saw that actually many people left just before the start of the discussion in breakout rooms. So we will ask for future Transeo Academy sessions whether people like it or not. So because you were a smaller group, we thought it might be good to meet all together in the main room and finalize the discussion. So Grégoire, are you there? Yes, it's there, but Juha, Oscar.
Okay. Yeah, can you hear me now?
Yeah.
Okay.
Yeah. So if maybe we can propose that, I was saying that many people left before the start of the breakout rooms. So it was a small group. So we are better here, I think. And so maybe you want to wrap up your group, or other persons would like to share what they have discussed.
We were actually in the middle of, it's a discussion very interesting. Juha was telling us, but it was the beginning, that the impact, what was the impact of the war in Ukraine, and he was in Finland and saying on Central Europe, maybe it's going to be a different perspective and maybe different dynamics. So we were, and I was actually, no. So that we're going to share that with now a larger group, which is great. And I think it would be very interesting to see, yes, what from you, what dynamics you say and what's impact of the war.
Yeah, well, thank you, Gregory. I guess my point was that when listening to this great presentation and hearing it here in Finland, the impact of Ukraine situation is affecting, at least according my experience, for the deal prices in this area. Why, how it makes the uncertainty bigger in our case, and it keeps buyers they are not willing to pay so much about the future that is very uncertain. Well, that was kind of my point. But anyway, thank you, Gregory, for your presentation.
I have a question. Do you see that on the prices, or do you see that also on the volume of the deal? There are less deals and people are just waiting to see what's going to happen?
Well,
or
I guess in Finland we have had, let's say, lower volumes for some time, so we should have a kind of high volume, but instead of having high volume, we have normal volume, so it's affecting the volume too. Yes.
Yeah. Okay. Which I expect to see also in more western part of Europe.
Mari, your mic.
Sorry. Oscar, Edwin, Jean-Luc, maybe you want to share like either a question or something you have discussed. And sorry, it was short. Sorry again for the breakout rooms, but it's better to exchange here.
But you had said it was a very filled pipeline with deals, and now it's back to normal. That we can confirm. There is in my opinion, Vichy was not quite on the same line, but in my opinion, there is slightly downward pressure on pricing and the amount of deals. However, we are not so much touched by the let's say global fluctuations, which is maybe more severe in France and Germany, mainly because a bit more industrial based economy. It's not I cannot emphasize that by research, but let's say the car industries, which is severely hit in Germany, and I can understand with Stellantis in France as well. This is not a whole economy, I know, but we think we are in Holland a little bit more diversified, so it hits, but it hits not so severe. That's our takeaway so far.
Thanks. Jean-Luc?
No additional comments from my side. It's very interesting to see the trend over 15 years and those data. My only point is that it's always very important. The introduction was for me very important. The opacity of the data, and then the segmentation. It's key because you see sometimes in some situation people who are willing to use those multiples in contexts where they are totally not applicable, and that's the danger of using those database without any expertise or without any prudential approach, I should say.
Okay, thanks.
That's the main problem we have. Actually, we've done like 15 years with Argus Index, and the idea again was trying to understand what's going on in the market. But the fact that a number of people use it, as a way to value companies, and we just keep on saying, it doesn't make any sense, and you can't do that. But you still have that on the market, and if you have people saying, "Oh, my company's worth, 9.5 times EBITDA," I say, "Well, your small company is 2 million sales in retail." No, it's not, but it's a long-term fighting. People not using properly data, and that's actually one of the reasons why we didn't publish, which actually we intended to when we started the Argus Index. We don't publish data on the sectors, just because I don't want people say, okay, my company is in food, etc., so it worth XYZ. And again, coming back to my slide on the difference between the standard deviation within sectors is very important to see that even within a sector, you just can't do that, and you can't automatize there are many things you can do, and we didn't talk about AI, and there are many things you can do, but you can't automatize valuation. I mean, that's my belief.
Good conclusion. So we're still useful.
I have a question to Gregory, if I may. What do you think it would be? What would be necessary to provide much more transparency about what I call the really bottom SME? Because opacity of transaction is the main obstacle, getting the data and appropriate context. But we are moving more and more with a world with full transparency about transactions and conditions. So maybe within the next years, we will be in a situation where all prices used will be available, and then it will be a great change for your job, isn't it?
It's a very good question, and I see exactly the contrary. I started in M&A, so I mean, intrinsically, it's going to be confidential, and people don't like to give anything about deals and prices. So that's the starting point. But we see, for instance, you have Paper in France, a great site where you have information, free access on companies, their accounts, their etc. And so you say, well, there's going to be great transparency, is what's going on. And actually, we've just finished, I was looking at something like 1,500 deals in France last year. And I was struck that like probably for 70%, 80% of the companies, they just now would not put their data or now you can have the possibility to give your accounts, but saying that it's confidential, which every company is doing. So now we have even less access to just the sales of the company. And if you look long term and I was struck also by this, like database, like Merge Market, PitchBook, and Argos have access to that. So we just have a look at what they're publishing. And interestingly, over the last 10 years, the number of deals for which the price was disclosed is more than divided by 2. And it's just not just people now less and less communicate in press release their prices. And today now on database, we see we've got less and less prices coming from press releases, and most of the time we have to go through checking into the accounts of holdings, board minutes, or etc., to try to find the price. So paradoxically, it is a no-pot market. It's still opaque. It is not getting better. And it's the same for also the disclosure of the ultimate beneficiary of a company. It went, France went back on this, and then it's not available anymore. And I think there are a number of countries not available anymore. So I don't see much, a trend to less opacity in that market. In a way, for Epsilon, it's not that news because it justifies what we're doing, and because we cannot automatize. It justifies the fact that there's no other way, and that's my conviction since I started Epsilon. The only way to get relevant information on that market is to go through the very long and painful process of getting that information. And again, coming to AI, you got, and I see on the market more and more companies, and that's what we're doing, getting automatically information on the market, but it's quite limited. It's always the same. It's and in every model, garbage in, garbage out. And if your company's and your information is not checked, or it's not worth much, and AI will not change this. And at the starting point, and thank you for building the data part of our. I went quickly on that, but I think it's key because that makes the difference in terms of reliability on also the studies behind this. The fact that you have to go through, and it's been very long and painful to build that database, I can tell you, but it's the only way. That's my
thank you very much.
Thank you. Edwin, the last word. Would you like to share?
Well, it's nice to see, Grégoire. Also, we're trying to get some grip on the market in the Netherlands. We have exactly the same problems.
Yeah.
And I copied 2 slides of your presentation, and it's that you throw all the EBITDAs on one pile and then maybe divide it in a different way. I agree. On market segment level, it's very difficult because there's not enough observations anyway. So it's good to see that we have the same, we share the same challenges. Let's keep
I
it.
think that's for all countries, and that's not only in Europe. For I can see, and I've tried a little bit to work in the US, and it's, I mean, it's pretty much the same. You don't have the information. It doesn't. That's the characteristic of the private market. It's a great market, but it's very opaque.
Marie, you are on mute again.
Sorry. Thank you so much for staying till the end, and I think it was really, really interesting. Thank you, Grégoire. I think you will join Transeo soon, so we will meet again.
Yes.
Hopefully in Italy.
We've known each other for a long time. I went to a number of Transeo events, and again, I find the fact it's really European and very diverse in terms of people are extremely interesting, because in every country it's very we're working in a number of associations, but they're each very national, very few really European ones. So that makes it very, very, very interesting.
So we look forward to meeting you soon again in person. And thank you so much. We'll follow up, sending you the email and with the presentation replay and so on. So thanks for your time, Grégoire. Wish you the best for Epsilon Research. I think you're going to grow in the coming years with more
Hopefully.
Projects. And
we have a lot of projects.
Yeah. So it's great. Congratulations. And thanks for your time. And thank you for attending Transeo Academy session.
Well,
and hope to see you soon.
Marie.
Thank you, everyone. Have a nice afternoon.
Thank you.
Bye-bye.
Have a nice afternoon. Bye.
Bye-bye.